Imagine this. Right now, as gold hovers above $4,900 an ounce and silver pushes past $84 after a wild ride through 2026 so far, most headlines scream bull market or safe haven surge. But behind the flashing tickers and celebratory posts, a hidden crisis is quietly building, one that top experts whisper about in private calls, but rarely shout in public interviews. It's not just another dip or correction. It's a structural fracture in the global supply chains for both metals, amplified by geopolitical chess moves, relentless industrial hunger, and a financial system that's printing money faster than minds can dig. Welcome to Elite Capital Decoded, where we pull back the curtain on the dangers Wall Street doesn't want retail investors to fully grasp. If this warning has your attention in these first seconds, hit that like button right now and subscribe, because ignoring this could cost you big when the real shock hits. Let's start with the surface story everyone sees: gold's relentless climb, driven by central banks hoarding record amounts, over 1,000 tons annually in recent years. ETF inflows resuming, and investors fleeing fiat uncertainty amid ballooning U.S. debt and geopolitical flashpoints. Silver's dual role shines brighter: safe haven appeal plus exploding use in solar panels, EVs, AI chips, and 5G infrastructure. Prices have doubled or more in short bursts, with silver's volatility turning small moves into massive gains for early holders. But peel back the layers, and the hidden crisis emerges. Supply isn't keeping up, and the cracks are widening in ways that could trigger violent repricing. Or worse, forced liquidations and access issues for physical buyers. Let's break this down step by step, like detectives following the trail of monthly candles that most investors miss. Silver's journey started accelerating in mid-2025. From lows around $29 early in the year, it climbed steadily through industrial tailwinds, tariff uncertainty, and safe haven flows. By late 2025, monthly closes turned consistently green, higher than the previous month's end. The streak built quietly: September 2025 green, October green, November green, December green, into January 2026. Even after January's wild spike to over $120 and a brutal correction, dropping 25-30% plus to mid-70s, February is shaping up green again, with prices rebounding hard from lows near $75 to current levels around $84 to $85. That's pushing toward 9 or 10 straight-up months, matching or breaking the 1980 record of 8 to 9 consecutive gains during the infamous squeeze era. What makes this streak different, and why the data tells a story most won't see? It's not speculation alone. The backbone is structural. The Silver Institute confirms 2026 as the sixth consecutive year of market deficit, projected at around 67 million ounces. Cumulative shortfalls since 2021 exceed 800 million ounces. Nearly a full year's global mine production evaporated from above-ground stocks. Supply? Total global output forecast at 1.05 billion ounces in 2026, up just 1.5%, a decade high but still lagging demand. Mine production flatlines, barely 1 to 2% annual growth. Recycling capped despite higher prices, inefficient for silver's dispersed uses, and new projects face years of delays from permitting, environmental rules, and capital crunch. Demand side is the unstoppable force, total around 1.1 to 1.12 billion ounces annually, with industrial holding firm despite some thrifting. Solar PV dips 7% to 194 million ounces from tech like Topkin, less silver per watt, but exploding installations worldwide offset it. EVs ramp aggressively, overtaking gas cars by 2027, using significantly more silver per vehicle. Batteries, contacts, sensors. Automotive demand up 3.4% CAGR through 2031. AI data centers, semiconductors, 5G, charging infrastructure, all inelastic high-growth needs. Investment stays robust. Retail coin/bar, buying chases scarcity. ETF inflows rebound post-correction, offsetting any jewelry/silverware softness. The hidden layer? Physical versus paper divergence, fueling the streak's resilience. COMEX registered inventories plunged below 100 million ounces recently, with massive deliveries. 49M plus January, 20M plus February. Coverage ratios thin at 23% on key months, open interest elevated. Eligible stocks buffer, but transfers only under pressure, signaling tightness. Shanghai backwardation at records pre-holiday. Premiums $10 plus over COMEX, pulling Middle East. China's export licensing, 44 approved firms for 2026 to 2027. Hoards 60 to 70% refined supply for domestic solar/EV/tech, fragmenting global flows. Post-Lunar New Year reopen amplified restocking, supporting green closes even amid volatility. This streak isn't fragile, it's backed by asymmetry. Dips get bought aggressively, $75 to $80 floors held. Structural tailwinds, green tech boom, East dominance, geopolitical noise, intact. Volatility high, January's 30% plus drop tested holders, but monthly resilience shines. Even corrections close higher than prior month ends. Analysts eye continuation. JP Morgan averages $81 for 2026, double 2025, with upside to $85 to $100 if deficits widen. Long-term, $150 to $300 possible as history rhymes with past bulls, but structural changes, industrial dominance, make it stronger. Why most won't see the story? Media focuses on daily swings or macro, rates, dollar, ignoring cumulative deficits draining stocks relentlessly. The elite, central banks, hoarding proxies, institutions positioning. No, retail chases headlines. This 10-month green streak could signal the maturing bull. Momentum meets fundamentals, turning paper rallies into sustained physical squeezes. On Elite Capital Decoded, we decode these hidden trends so you win. If silver's historic streak excites you, comment below. Holding for the 10th green month? Target $100 plus this year? Share with metals friends. Let's fuel discussion and uncover elite capital together. Thanks for watching. Stay vigilant. The streak might just be getting started. Stay sharp.